Bonjour. Bonjour. Antoine.
Est-ce que vous voulez avoir la lecture du règlement en français ou bien en anglais?
Pas fort.
Chaque équipe dispose de 20 minutes afin de présenter son cas au juge. J'afficherai le carton pour les 5, les 10, les 5, les 2 dernières minutes et les 30 dernières secondes avec les petits cartons. Lors des 10 dernières secondes du discours, j'indiquerai à l'aide de mes 2 mains le nombre de secondes restantes. Si vous n'avez pas terminé votre présentation après 20 minutes, elle se verra arrêtée afin de passer à la période de questions. Une période de questions d'une durée maximale de 5 minutes est allouée au jury à la fin de votre présentation. Veuillez noter que vous ne pouvez en aucun temps dévoiler le nom de la provenance de votre université. Je laisse maintenant la parole au juge afin de se nommer. Vous pourrez ensuite débuter votre présentation.
Bonjour, mon nom est François Trouche, je travaille pour Desjardins Sécurité Financière au CFL ou au siège social.
Bonjour, mon nom est Martin Poirier. Je fais partie de l'équipe de direction du Centre financier CFL.
Mario Lavallée, professeur de finance à l'Université de Charles. On peut débuter? Oui. Right. Good afternoon, Monsieur La Jeunesse. Today your company is facing slowing growth, and you need to find a solution how to revive the growth that your company has experienced since you have acquired it in 2009. Now today us, Olympus Capital Advisors, presented by Antoine Arbeau, Paul Rigange, and myself, will show exactly how to do that. Next slide, please. So first of all, in our presentation we'll go So first of all, our mandate today was to evaluate the strategic alternatives for SLF Hochelaga to restore its growth to how it was since its acquisition. Now our key considerations today is to choose the best strategy that will provide the highest growth potential and the deal structure of how we're going to do that. So moving on to the recommendation, we recommend to acquire 70% of Cliff Doll at a valuation of $2 million. Now moving on to the analysis of what exactly drives this acquisition on our side. On our side is the slowdown of growth that your company has experienced. Now, it's believed that the slowdown of growth is a structural industry slowdown, and also there's an element of lower productivity of the new employees within the company. And this productivity is not only lagging in terms of senior against junior employees, junior against senior employees, but also it's lagging compared to the whole network of SLF. Now, what drives the sale of Cliff Doll? Moving on to the next slide. Now basically it's the uncertainty in the independent market. It's the consolidation of general agents that really is a result of increases in compliance and information technology that drive the consolidation of the general agents, basically putting negative pressure on their margins. Now it's also the fact that manufacturers are streamlining their business, and basically that resulted in a loss of a general agent to Cliff Doll, and as an effect, it negatively affected the gross margins of the company. Now the company is facing uncertain times, and it's a perfect time for it to be sold. Now, what are what is our strategic rationale? Basically, our company is facing sloppy succession efforts. First of all, we have decreased sales on the transferred account that has been transferred from senior people to more junior people, and also the fact that 50% of the workforce are 55 and older. This will put further pressure on the succession as more and more people will be willing to retire. They'll have to transfer their accounts, and by transferring these accounts, we may face additional sales decreases. Now, the sales from new employees stagnate compared to senior, and this really points out to the fact that maybe our training is not that efficient because it doesn't produce as good of results in new employees compared to those that are senior, and also the productivity of SLF network in general is higher than what we are experiencing. So this is basically pointing to the fact that we should not choose an internal growth strategy where we'll hire more people, as these facts point to the fact that maybe we're not as good in training and developing our employees, which really leads us to our alternative that we have chosen to acquire Cliff Doll. Next slide, please. So the strategic rationale here is very simple. It's a very attractive workforce. First of all, they're young, they're educated, they're motivated because they feel that they want to stay in this industry, they want to stay in this type of sales, and they have great industry knowledge. And how it really ties to our problems right now is that we have an older older workforce of employees that will be retiring, and as they will be able to assume the retiring accounts, and this will really avoid the decrease in sales that we have experienced. Now it's also a perfect timing. The company that we're willing to acquire, they're facing turbulence, and we are facing an opportunity of increasing growth. So the opportunity really matches our needs. Now, basically, which price we would be able to pay for the company, and which price we would be willing to pay for that, and Antoine will work for that.
Thank you. Now that Stas has drawn an accurate picture of the current situation, I'll show you how exactly we came up with a valuation of $2 million. So first, a valuation overview. So we did some operational assumptions on the business that we are going to acquire moving forward. And that resulted into an income statement from which we then derived a discounted cash flow analysis to value the opportunity that was presented to us. So for that, we did a WACC buildup as well as a sensitivity analysis to really analyze the returns and value the company under different assumptions. Finally, we also did an accretion analysis to analyze the deal terms and really see what's the potential for increasing shareholder value of our current company. So starting off with the assumptions. So first, moving forward, we assume that insurance sales growth as well as savings product sales will increase year over year by 2%. That's a conservative assumption since first, we know that historically the sales has grown at about 3–4%. And also, really, it points to the fact that we're not seeking growth in, or actually we're not seeking value in aggressive growth, but rather just in increasing and sustaining that growth by capturing these employees and integrating them into our business. Now, on the gross margin assumptions, we've kept and straight-lined the insurance sales gross margins, as well as the savings product sales gross margins, respectively, for the business's two segments. And now, the expenses, operating expenses as a percentage of revenue. So first, we have the salaries and benefit, which will be mostly straight-lined, as these are mostly variable costs, so we don't see them to increase in the future as a percentage of revenue. Second, the occupancy expense, that's mostly a rent that is partly outsourced to the consultants and sales force. So we see that it will decrease as a percentage of revenue since it's mostly a fixed expense. Then advertising and promotion, we're seeing a lot of competitive pressures in the market, so for that reason we forecast that they'll have to increase slightly their promotion efforts. And then basically the insurance, depreciation, and other operating expenses are mostly variable costs. So we're pretty much assuming a straight line percentage of sales. And then tax rate, which will remain constant at 19%. From that, we really built an income statement of the company, so based on a 5-year projection. And here, if we're comparing the CAGR, 5-year CAGRs of the first 5 years with those of the projected 5 years, we can see that the assumptions are quite realistic and conservative, but really I was just to back check whether it made sense, projections made sense, versus what has been generated by the business historically. Moving forward, before we derive the cash flows from the business, we actually needed to build a quick working capital schedule. We did not have any balance sheet information for that business, so we assumed that the working capital as a percentage of sales, actually of the turnover, would be approximately 5%. So moving forward, that the change in net working capital would be approximately $1,000, which is pretty much immaterial and inconsequent, but still we need to factor it in the valuation. So the impact on cash flow will actually be negative. Moving forward, so we're starting with the EBIT, which was drawn from the income statement, then adjusting for taxes. We get the EBITDA, or the earnings before interest after taxes, otherwise known as the NOPAT. Then we make adjustments for depreciation, which was in our income statement. Then for CapEx, and since it's a really asset-light business model, we assume that CapEx should approximately equal depreciation over the long run. So that's that for depreciation and CapEx, and then plugging in our change in net working capital, which we just computed, we get the unlevered free cash flows of the business for the 5 years of projection. Now, before we actually discount these cash flows, we need to do a quick WACC buildup. So first, assuming a risk-free rate of 3%, which is proxied by a 10-year bond, treasury bond. Then a beta of 1.5%, which would be kind of the beta we would observe in the market for a similar company. However, this is a very specific company, and that's why we've also added some specific premiums. So for example, a size premium of 5%, as well as a liquidity premium of 10%, because this is a private company, so reselling that equity stake to another investor would be quite costly in terms of liquidity, so we really have to factor that in, our expected return and discount rate and so on. And then finally, a market risk premium of 6%. We got a cost of equity of 27%. Now on the debt side, cost of debt, we know that the parent company can actually finance 70% of the transaction at an interest rate of 5.8%. Now after tax cost of debt, that amounts to 4.7%. And now, given the target capital structure weights, which we've assumed, we get a WACC of 15.8%. And we also assume a terminal growth rate of 1% to value the company. Moving on forward, we get the unlevered free cash flows. We also compute the terminal value, which really represents the value that will be generated by the business beyond 2018. Then adding all of these cash flows together and discounting them to the weighted average cost of capital, we get an enterprise value of $2.8 million. Well, that seems a bit high when we compare it to what the current owner has proposed us. But we seem like we've really questioned our assumptions and established that they're conservative, they're realistic. So we believe $2.8 million actually makes sense. And when we're comparing that with the value that we are going to offer, so we're actually proposing a 75% stake at a $2 million valuation, that amounts to about $800,000 in value creation for our shareholders, which on a relative basis represents 41%. And now just a quick sensitivity analysis to factor in the different assumptions we've made. So of course the weighted average cost of capital and the terminal growth rate, and we can see the effect on the valuation of these assumptions. And for example, just a quick example why the weighted average cost of capital could go up to 19% could be simply due to the fact that maybe a liquidity discount of 10% isn't enough. Things like that to stress test really our basic assumptions about valuation. And then on the second sensitivity, you can see the actual accretion that the related valuations would entail on our business. So the current valuation creates 41% for the shareholders. But it can go way up, way more high, and it could go lower as well. But we can see that it's always positive, even if we really stress test the assumptions to the maximum. Now moving forward, there's also the debt. The debt is really important as most of the deal will be financed with debt, and that was taken into consideration in the WACC build-up as we assumed a target capital structure of 50% debt, 50% equity. However, we still have to be sure that the company is still able to meet these payments. So first, so it's amortized over 10 years. So the value of the debt is $1.4 million. That results in $140,000 in amortization per year, plus the remaining balance after 5 years. And we can see that the cumulative cash flows more than cover these debt repayment needs. So there's no worries on the debt side. Moving forward, we also did a quick accretion dilution on a net income basis. So we did some quick assumptions. So the deal value was of $2 million, that's what we proposed. And part of that will be financed with debt, which represents 70%. The other assumptions were interest expense of 5.8%, deal fees of 2%, as well as amortized financing fees for the debt that was raised to finance the deal of 1%, and the loan term is of 5 years. So now, if we see the actual accretion dilution, we can see that if we combine the two companies' pre-tax income and we adjust for the incremental interest expense that will be incurred, as well as the deal fees and the amortized financing fees, which will be amortized over 5 years, we get a pro forma pre-tax income of $946, which gives a pro forma post-tax net income of $766. And really, the SFL standalone net income is only of about $500,000. So we see that on a net income basis, we actually create 52% of shareholder value accretion. Moving forward, Paul will walk you through the implementation and show you how we're really going to structure and leverage that deal.
Thank you, Antoine. So now that Stanislav walked you through the rationale behind the deal and Antoine presented you the valuation that supports it, we need to go through the implementation and see how it goes. So first of all, we came up with this negotiation strategy. We know that Mr. Lafortune estimated his business at $1.8 million. So that would be our first bid. Now, negotiations can move along and we would come up with a counter bid of $2 million, which is included in our recommendation. And considering the valuation of $2.82 million of the business, that price would be our reservation price, and we would walk away from that deal if Mr. Lafortune would ask as much as that. Then we came up with clauses that would protect you in this deal and protect the shareholders' interest. First of all, the breakup fee. So what it means exactly is that we would require a breakup fee of 5% of the deal value upon intentional termination, meaning that we signed a confidential agreement and we started negotiating. If for whatever reason Mr. Lafortune would walk away and leave us without anything, we would require 5% of the deal's value. And also there's a material adverse change clause that we came up with, and the reason behind that is that 2 years ago Clédor actually lost one of the best suppliers in terms of insurance products, and this really decreased the value of the business. In the event of this would happen again when one of the best suppliers, we would require this clause that would leave us walk away from this deal without any fees from both sides, because it would probably be less attractive for us and we would not be interested in. Then the no-show provision. So what it means exactly is that it will allow us to obtain the exclusivity during negotiations, and it would prevent Clédor to look for other buyers in the meantime during our negotiations. Finally, the earn-out. So the way it works is basically 75% of the company right now is owned by Mr. Lafortune, and the 25% left are owned by Mr. Labranche. And basically, SLF can finance up to 70% of the deal. So the 30% would be remaining. Instead of putting our money right away during the deal, what we would do is we would come up with this earn-out of the 30% left in order to keep him in the business, because it's crucial. He has the highest client list and he has the highest sales in insurance and in savings. So the deal structure, so as I mentioned, 75% is owned by Mr. Lafortune, and we're going to buy back his shares. So the 70% are financed by debt, and we're going to acquire them right now. 30% left, we're going to implement this earn-out. So Mr. Lafortune is 60 years old, so he's going to retire anytime soon. So we plan on this paying out this earn-out within 5 years maximum. And basically why we require that is because his share of the pie is so important in this deal, in this business, that if he was to retire right after the deal, we would lose value in this. And therefore, we deem important to keep him in the business with this incentive. And also, why we didn't acquire the 25% left is because Mr. Labranche really wants to sell his shares to his son, who's actually working in Clédor too. The reason why it's not done so already is because his son cannot afford to buy back this 25% of shares. But that being said, we require only the majority, and therefore we're fine with leaving this 25% to Mr. Labranche so far. So the timeline of the deal so far, management of both teams, they've known each other for a long time, and they've contacted each other. They signed a confidentiality agreement, and Clédor sent the SIM confidential information memorandum to SLF. So that is done already. Now within the next month, we will, depending on the information we received, and if we're interested, which we are, we'll send an intent of interest to Clédor. Then within the next couple of months, we require both management to have meetings in order to fix some issues that we might find on both sides of the business. After these meetings, we estimate that within the 4th month, we'll send a letter of intent with a fixed price for the deal. And to finalize the deal, we'll write a purchase agreement which will legally bind the two parties in order to close the deal, which we estimate to be closed within 6 months. So, in order to conclude, we see this deal as creative. It adds value to our business right now. It will definitely solve this problem of growth, and this is why we recommend this to go through this deal as soon as possible. Well, thank you very much for your time and for the questions.
Thank you. Do you look at the other opportunity, the internal growth possibility with cash flow or quantitative numbers?
We did not perform a quantitative analysis because we thought that the assumptions we have to make would be of a higher degree of uncertainty, and these were fairly less uncertain, if you will. So for that reason, we thought these numbers would satisfy us, and we thought it was a great deal. And moreover, we thought that maybe training a workforce would require much more time than simply acquiring one that is already trained. And we thought that this alternative was much more attractive on these bases.
In the acquisition scenario, have you thought of bringing the company merge with the existing operations to make synergies?
We did. These would mostly result maybe in revenue synergies. So by maybe tapping in the distribution network of the parent company, so they would, because they have a hybrid business model where they sell through exclusive and non-exclusive, so they could maybe sell some of these products. We did not perform a quantitative analysis. We considered it, but we really wanted to see whether value could be created only from a base case scenario.
So right now it's a standalone investment, and we keep it that way until we know what Mr. Labranche is willing to do.
Exactly. Okay. And if it's possible with the franchise and so on, distribute the new products.
In terms of options to be considered, this case was presented as having two options. Either you hire new employees and you form them, or you buy. Is there any other options you saw between the lines in that case?
Well,
well, considering the fact that we're a hybrid, our client is a hybrid business model, working with Desjardins and offering at the same time other products. We think that they cover pretty much a large deal of solutions in order to restore the growth. Can't think of an option right now.
As Mr. Lafortune is stated that his business was valued at $1.8 million, why not offer a lower price as a first bid?
He's not.
Why start at 1.8?
Well, we actually, so we did start at 1.8. We have considered maybe, in fact, maybe starting off with a lower offer. However, we did not want to create any negative goodwill from the other parties that had maybe power in the decision-making process on their side, because we know there's a lot of tension in the current company's ownership, and we did not want to come out as being aggressive, especially since we've seen a lot of accretion on the valuation part.
Yeah, but what would you consider to be too aggressive? 1.5 million would be aggressive. 1.7 million would be not too aggressive.
Maybe not.
Expected.
Yeah, expected, exactly. Expected by Mr. Lafortune. Doesn't expect you to come back at 1.8 and start negotiating at 1.8.
I agree with Mr. Lafortune's point of view.
Yeah.
But really, why we did that was really because of the other shareholders. So the minority shareholders, which, even though they were minority, had a minority position, still had some say in that deal. So I want to consider everyone's interest in that deal.